Hi class, today we are going to wrap up our study of the mathematical finance. So that branch of mathematics, the financial aspect. And we're going to do that by looking in 11.4 at stocks, bonds, and mutual funds. And then in 11.5, we're going to focus specifically on home mortgages, probably a topic that is very applicable to us in a very real way. So in 11.4, we're going to start with stocks, and just a simple kind of definition of what stocks are. When you purchase a stock, right, you are actually purchasing a portion of ownership in a company. So you, in a very real way, become owner. Now, obviously, a lot of big companies who sell their stocks have silent partners or silent owners. So you may not be directly involved in the day-to-day running of the business, but you are a shareholder. You are part owner of the business. And that means that as such, you share in the profits. So when a company is profitable, shareholders get paid dividends, which is usually a preset thing of, how the dividends are paid out per share or per stock. And then the people who own the stocks are called stockholders or shareholders. So you own a share of the company. Okay. So dividend yield is a term that's used when we talk about stocks, and it's very similar to a simple interest rate. So if you consider what you paid for a share in the company or what you paid for the stock versus what you have been paid back in dividends, so what you have profited, you can use those numbers to calculate a dividend yield, which gives you an idea of what the interest rate is on that stock, right? Are you making 2%, 10%, whatever? So you're going to see how to calculate that. Again, most of the calculations in this chapter, when we're talking about stocks, bonds, and mutual funds, are simple calculations. It's more about learning the correct terminology. And then also, you're going to actually look at some stock market reports and have to identify the numbers in those reports that you need to make the calculation. So the dividend yield is one of those numbers that you'll use, the cost of the share. And so your textbook kind of has a pre-built chart in there for you that would look very similar to any chart that you could go look up on the stock exchange, the market, and kind of make sense of what all those numbers mean. All right, so you're going to get some practice with that. The second thing that we're going to talk about is bonds. So bonds might at first glance seem like stocks, but they are different. With stocks, you are purchasing ownership in a company. You become part owner. With bonds, you are actually lending money to the company. So governments use bonds, companies can use bonds. So what they're basically doing is saying, we need this much money. We would just like to borrow it. We don't want to sell you ownership in our company. We don't want to give you those rights. We don't want you sharing in our profit, but we do need money. We need some capital. So we would like to borrow money, but they spread it over lots of people, right? The public, the general public. And you can buy a bond and the company gets to use your money and they agree to pay you back a set amount at a certain time, based on whatever the interest rate is and whatever the time frame is, right? So it's very much just like, it's a loan, right? You are loaning money to the company and they agree to pay you back at a certain time. Governments do it to raise money for, when they need to pay for roads or whatever things, or just run a deficit, as some governments do. So that's a bond. A bond is not purchasing part of a company. It is loaning money to a company. So you will look at how to calculate that. It's actually, similar to problems we've already looked at when we've dealt with car loans and other things. And then the last thing we're going to look at in 11.4 is investment trusts. The most common and probably a term you're familiar with would be a mutual fund. So mutual funds are funds that are owned by companies that these companies, they don't make or manufacture anything, right? They simply purchase stocks and bonds. They purchase both and they put them together in what's called an investment portfolio. And their hope is that this collection as a whole will make them money or will make their customers money. So you can, from a from a company that manages mutual funds, right? You can invest your money. You can say, hey, I have this much money for you to invest. They buy a set groups of stocks and funds with all their customers' money. And the hope is that, 5-10 years down the road, all their customers will have made money. So the benefit of that is you have professionals who specialize in understanding the financial markets. They have a vested interest to make themselves money, and so they are trying to make you money. But that's their job, right? To watch the markets, to manage the funds, to be profitable. And so that's the benefit of using that, as opposed to, say, you investing your money yourself. You have to, check all the stocks, choose the stocks, manage the stocks, when to sell, when to buy, and the same with bonds. So a lot of people opt for that route, right? That mutual fund route. So their calculations are a little bit more complex because it's not a single stock or a single bond. It's a large collection of many. So a lot of times you'll talk about the net asset value of the fund. So instead of what is this fund, like what is Apple worth or what is Google worth, right? You would be talking about all of my funds together. If I put all my stocks and all my bonds and I add them all up, what is that worth? And so that is called the net asset value of a fund. And you have a formula that's going to help you calculate that based on what is in the mutual fund. So that's pretty much 11.4. It's just kind of helping you distinguish between those three different types of investments and how they differ and how you can calculate their values. And then in 11.5, we're going to switch to mortgages, home ownership. So you'll see a lot of similarities between the formulas you should in home mortgages that we used with loans and car loans and things like that. But mortgages have some added things that they include that we want to figure out how to deal with. So if it was just like a car loan, like, hey, we're borrowing this money, we're buying the house, we're paying it back, you know how to do that. It's the same calculation. But mortgages often include the added additional parts, car loans can too, of down payments. So we're going to talk about how to incorporate a down payment into calculating your payment amount. And so you can kind of play with that down payment and see how much difference it makes long term in what you have to pay for. The other thing that mortgages deal with that we need to take into account are closing costs. So sometimes closing costs are just a set amount, but a lot of times they are calculated based on points. And so your textbook is going to kind of walk you through what that means when it says points and how you can use the loan amount to calculate the points and the closing costs, so you know exactly what that looks like, because the closing costs vary based on the parameters of the loan. So you will see how to add in the down payment, how to add in those closing costs, and see how that impacts the total loan payoff and the payment amounts. And then the final piece of owning a home is that there are long-term costs that mortgages require you to have and usually require you to pay to the mortgage company so that they can ensure they're being taken care of. And those are your taxes, your property taxes, and your insurance. So almost all loans require that to be managed through them. So those are also added to your payment. So instead of just your loan and your payment, right, you also have this added part of insurance and taxes. And so the last step in 11.5 is going to walk you through, once you've dealt with the borrowed amount, how do I take my taxes and my insurance to calculate the total final payment that I'm going to be making each month. And that will close out our study in finances and almost close out the semester. We have one more topic that we will hit next week, and then you will have completed contemporary math.